Hello, traders. Almost everyone knows how to trade reversals, and most traders are loaded with reversal entry models. But when it comes to continuation, that's where traders get lost. They can't spot it in real time, and most don't have a clear model to trade it. That's exactly what we're going to fix in this video. This model is designed to explain and execute how trades can be taken in alignment with the continuation of a higher time frame narrative, while using lower time frame precision for execution. The primary objective of this model is to participate in movements that are driven by higher time frame intentions, specifically by targeting the higher time frame draw on liquidity, while entering those trades from the lower time frame with accuracy and control. The process begins with identifying the higher time frame context. This includes understanding market structure, directional bias, and the areas where liquidity is most likely resting. The higher time frame provides the overall roadmap. It defines where price is expected to move, why that movement is likely to occur, and which liquidity pools are being targeted by the market. Once the higher time frame direction and objective are clearly defined, the model does not attempt to enter trades randomly or impulsively. Instead, it waits for price to retrace or pause in a manner that allows alignment with the higher time frame continuation. This patience is essential, because the purpose of the lower time frame is not to predict direction, but to refine execution. On the lower time frame, the model looks for specific confirmations that indicate the market is preparing to continue in the direction dictated by the higher time frame. These confirmations include the removal of opposing liquidity, the creation of imbalance through strong price movement, and the formation of structures that show acceptance in the higher time frame direction. Lower time frame signals are only considered valid when they clearly support the higher time frame objective. The model does not trade lower time frame movements in isolation. Every entry must serve the larger narrative established by the higher time frame analysis. In simple terms, the higher time frame answers the question of where price wants to go, while the lower time frame answers the question of when and how to enter the trade. This model is built on alignment rather than prediction. It combines higher time frame intention with lower time frame confirmation to achieve precise entries, controlled risk, and participation in sustained market movements. The ultimate goal of this model is to use lower time frame execution as a tool to capture higher time frame continuation moves, ensuring that every trade is taken with clarity, structure, and purpose. This section explains how the market will be approached using the continuation model and the specific concepts that support it. To maintain clarity and consistency, this continuation model operates using only 3 time frames. These time frames are the 1-hour time frame, the 5-minute time frame, and the 1-minute time frame. No additional time frames are included in the analysis. This limitation is intentional, as it allows the model to remain focused, structured, and repeatable. Each time frame has a specific role. The 1-hour time frame is used strictly for higher time frame analysis and directional context. The 5-minute time frame is used for refinement and alignment. The 1-minute time frame is used for precise execution. In addition to time frames, this model relies on specific price delivery arrays. The primary price delivery arrays used in this model are breaker blocks, order blocks, and fair value gaps. While other price delivery arrays exist and may be referenced, the main focus remains on these 3. This ensures consistency in analysis and avoids unnecessary complexity. The next step is understanding how these tools are applied together. The first action taken in every analysis is to move to the 1-hour time frame. All analysis begins here. The 1-hour chart is the foundation of the entire model. On the 1-hour time frame, the first and most important task is to identify the draw on liquidity. Without a clearly defined draw on liquidity, there is no justification for taking a trade. Any trade taken without a draw on liquidity is considered a blind guess and is not part of this model. The draw on liquidity can take multiple forms. It may be equal lows, areas of low resistance liquidity, or unfilled price delivery arrays that price has not yet mitigated. These areas represent where price is most likely to be drawn. Once the draw on liquidity is clearly marked, The next step is to identify points of interest. Points of interest are areas from which a trade may be executed in alignment with the higher timeframe objective. These points of interest are typically unfilled fair value gaps located in either premium or discount, depending on the direction of the draw on liquidity. If the draw on liquidity is bearish, the model focuses on unfilled fair value gaps located in premium. If the draw on liquidity is bullish, the model focuses on unfilled fair value gaps located in discount. While fair value gaps are used here as a primary example, they are not mandatory. Order blocks or breaker blocks may also be used as points of interest. The specific type of price delivery array is flexible, but one condition is non-negotiable. Every selected point of interest must align with the defined draw on liquidity. If a price delivery array does not support movement toward the draw on liquidity, it is ignored. Alignment with the higher time frame objective is always the priority. This completes the 1-hour time frame portion of the model and establishes the foundation for all lower time frame execution. After the draw on liquidity and price delivery arrays have been fully aligned on the 1-hour time frame, the model transitions to the 5-minute time frame. The 5-minute time frame is not used to redefine bias or to introduce new objectives. Its only purpose is to observe how price reacts when it returns to the higher time frame point of interest. On the 5-minute time frame, the model waits patiently for price to retrace back into the price delivery array that was previously marked on the 1-hour time frame. No action is taken before price enters this area. If price does not retrace into the higher time frame price delivery array, no trade is considered. Once price enters the higher time frame price delivery array, the model begins to observe price behavior within that zone. The key objective on the 5-minute time frame is to determine whether liquidity is being taken inside the price delivery array. If the higher time frame draw on liquidity is bullish, and the selected price delivery array is a fair value gap located in discount, the model waits for a sell-side liquidity sweep on the 5-minute time frame. This sell-side liquidity sweep indicates that opposing liquidity is being removed, while price is positioned within an area that supports higher time frame continuation. If the higher time frame draw on liquidity is bearish, and the selected price delivery array is a fair value gap located in premium, the model waits for a buy-side liquidity sweep on the 5-minute time frame. This buy-side liquidity sweep serves the same purpose, confirming that opposing liquidity is being taken before continuation in the higher time frame direction. The same logic applies regardless of whether the price delivery array is a fair value gap, an order block, or a breaker block. The type of price delivery array does not change the requirement. Liquidity must be swept within the higher time frame price delivery array. There is no additional complexity introduced on the 5-minute time frame. The model does not search for entries, does not execute trades, and does not attempt to predict movement. The only responsibilities of the 5-minute time frame are the following. First, confirm that price has retraced into the higher time frame price delivery array. Second, confirm that a liquidity sweep has occurred within that area. If both conditions are met, the model prepares for execution on the lower time frame. If either condition is missing, the setup is considered incomplete, and no trade is taken. This completes the role of the 5-minute time frame within the continuation model. At this stage, all higher time frame and intermediate time frame conditions have already been satisfied. The draw on liquidity has been defined on the 1-hour time frame, the price delivery array has been selected, and a liquidity sweep has occurred within that area on the 5-minute time frame. With these conditions met, the model transitions to the 1-minute time frame. The 1-minute time frame is used exclusively for execution. No new bias is formed here, and no higher time frame decisions are altered. Once on the 1-minute time frame, the model waits for entry confirmation. The model does not enter immediately after the liquidity sweep. It waits for evidence that price is prepared to continue in the direction of the higher time frame draw on liquidity. Entry confirmation can take the form of any price delivery array that clearly supports continuation. This may include a fair value gap, an order block, or a breaker block that forms after the liquidity sweep. The specific price delivery array used for confirmation is flexible as long as it aligns with the higher time frame objective. One of the most reliable forms of entry confirmation in this model is a market structure shift. A market structure shift indicates that control has transitioned in favor of the higher time frame direction after liquidity has been removed. For a bullish continuation, the model looks for a shift in structure that confirms higher lows and higher highs on the 1-minute time frame following a sell-side liquidity sweep. For a bearish continuation, the model looks for a shift in structure that confirms lower highs and lower lows on the 1-minute time frame following a buy-side liquidity sweep. The entry is executed only after this confirmation is clearly present. The model does not attempt to anticipate the shift. It reacts only after confirmation is established. There are no additional requirements on the 1-minute time frame. The model does not overanalyze or add unnecessary conditions. The focus remains on clarity, alignment, and execution. In summary, the 1-minute time frame serves a single purpose: to provide a precise and confirmed entry that aligns with the higher time frame draw on liquidity and the continuation narrative. This completes the execution phase of the continuation model. Now let us walk through a practical example to demonstrate how this continuation model is applied directly on the charts. The analysis begins on the 1-hour time frame. The first and most important step on the 1-hour chart is to identify the draw on liquidity, which also defines the directional bias. On the 1-hour time frame, we observe a sell-side liquidity sweep. Below price, liquidity has already been taken, and above price, there are equal highs resting. This information clearly indicates bullish intention. Based on this context, the directional bias on the 1-hour time frame is bullish, and the draw on liquidity is the equal highs resting above price. After identifying the draw on liquidity, the next step is to define the dealing range. The model marks the first range that forms after the 1-hour sell-side liquidity sweep. This range becomes the reference for determining premium and discount. Once the range is established, the discount and premium zones are clearly marked. Since the draw on liquidity is bullish, the model focuses exclusively on areas located below the discount level. Within this discounted area, the model looks for a price delivery array that can serve as a point of interest. In this example, a fair value gap is present on the 1-hour time frame below discount. This fair value gap becomes the selected price delivery array and the location from which the trade will be planned. With the 1-hour analysis complete, the model then transitions to the 5-minute time frame. On the 5-minute time frame, the objective is to observe how price behaves when it retraces into the higher time frame fair value gap. Price does retrace into this area, and while inside the price delivery array, a sell-side liquidity sweep occurs on the 5-minute time frame. This confirms that opposing liquidity is being removed within the higher time frame point of interest. With this condition satisfied, the 5-minute step of the model is complete. The final step is execution, which takes place on the 1-minute time frame. On the 1-minute chart, the model looks for entry confirmation after the liquidity sweep. In this example, an inverse fair value gap forms following the sell-side liquidity sweep. This inverse fair value gap aligns with the bullish draw on liquidity and provides a clear entry confirmation. The entry is taken at the inverse fair value gap on the 1-minute time frame. The stop loss is placed safely below the most recent swing low, ensuring that risk is clearly defined and logically positioned. The target for the trade is the higher time frame draw on liquidity, which in this case is the equal highs resting above price on the 1-hour time frame. This completes the full execution of the continuation model, from higher time frame analysis to lower time frame entry, with every step aligned to the same objective. The example demonstrates how structure, liquidity, and time frame alignment work together to create a clear, repeatable, and disciplined trading approach. After the initial entry becomes active, the model shifts its focus back to the 1-hour time frame to reassess higher time frame structure. On the 1-hour chart, a clear structure shift to the buy side is observed. This structure shift confirms that bullish control has strengthened and that the higher time frame continuation remains valid. Following this structure shift, a new range is formed on the 1-hour time frame. This new range is used to once again mark premium and discount zones. Each newly formed range is treated independently as it provides fresh opportunities to align with the same higher time frame draw on liquidity. After marking the discount and premium of this new range, the model identifies the most discounted price delivery array within the range. In this case, an order block is located below the discount level. This order block becomes the new point of interest for a continuation entry. With the new higher time frame point of interest identified, the model transitions to the 5-minute time frame. On the 5-minute chart, the model waits for price to retrace into the 1-hour order block. While price is inside this price delivery array, the model observes whether sell-side liquidity is swept. In this example, a sell-side liquidity sweep clearly occurs within the order block. This confirms that opposing liquidity is being removed while price remains aligned with the bullish, higher time frame objective. With this confirmation, the 5-minute time frame requirements for this range are fully satisfied. The model then shifts to the 1-minute time frame for execution. On the 1-minute chart, immediately after the liquidity sweep, strong bullish displacement is observed. This displacement is accompanied by a clear change in the state of delivery, indicating aggressive participation in the bullish direction. Given the strength and clarity of this displacement, the model allows for execution using a market order immediately after the displacement candle closes. The stop loss is placed below the most recent swing low, ensuring logical and protected risk placement. At this stage, the model also allows for active trade management. The stop loss of the previous position may be trailed to the stop loss level of the new entry, effectively reducing overall risk, while maintaining exposure in the direction of the higher time frame draw on liquidity. The target for this continuation entry remains unchanged. The objective is still the equal highs identified on the 1-hour time frame, which represent the primary draw on liquidity. This example demonstrates how the continuation model can be applied multiple times within the same higher time frame narrative, allowing for re-entries, position building, and structured trade management without deviating from the original objective. Each entry is taken only after full alignment across all time frames, ensuring consistency, discipline, and clarity throughout the entire trading process. After the second trade is completed, the model once again returns to the 1-hour time frame to reassess the higher time frame structure. The first step is always the same. The model checks whether a new structure shift has formed on the 1-hour time frame. In this case, another bullish structure shift is clearly present. This confirms that the higher time frame continuation remains intact. Following this structure shift, a new dealing range is formed. The model marks the premium and discount zones of this newly formed range. As always, since the draw on liquidity remains bullish, the model focuses only on price delivery arrays located below the discount level. Within this discounted area, an order block is identified. This order block becomes the next potential point of interest for a continuation entry. After marking the order block on the 1-hour time frame, the model transitions to the 5-minute time frame to observe price behavior. On the 5-minute chart, the model waits to see whether price retraces into the higher time frame order block. However, in this scenario, price never returns to the discounted area. The order block remains unfilled, and price continues to move higher without offering a retracement. In situations like this, the model takes no action. No trade is forced. No lower quality entry is accepted. The model operates on the principle that if price intends to offer a valid trade, it must return to a favorable price level. Since price does not retrace into the order block, the setup is considered incomplete. The model simply ignores this opportunity and shifts focus back to the higher time frame. Once again, the model evaluates the 1-hour chart to check for any additional structure shifts. A new bullish structure shift forms on the 1-hour time frame. This confirms continued strength and ongoing pursuit of the same draw on liquidity. As before, the model marks the premium and discount zones of this new range. It then identifies a price delivery array located below the discount level. In this example, another order block is present and is marked as the potential point of interest. The model then transitions to the 5-minute time frame to wait for a retracement into this order block. Once again, price does not return to the discounted area. The order block remains untouched. Despite this, price continues to move aggressively higher and ultimately reaches the predefined target. The draw on liquidity, which is the equal highs on the 1-hour time frame, is fully achieved. This sequence highlights one of the most important principles of the continuation model. Not every valid higher time frame setup will provide a lower time frame entry. The model does not attempt to participate in every move. It only participates when price offers alignment, confirmation, and favorable pricing. By refusing to chase price and by avoiding unnecessary trades, the model preserves discipline, reduces emotional decision-making, and maintains long-term consistency. The trade objective is fulfilled not because of constant participation, but because of patience and strict adherence to rules. This concludes the full example of the continuation model in action, from initial bias formation to final delivery into the higher time frame draw on liquidity. This is how the continuation model is designed to be executed. The continuation model is built on alignment, patience, and structure. It does not rely on prediction, impulse, or frequent participation. Every decision within the model is guided by higher time frame intention and confirmed through lower time frame execution. The process always begins on the 1-hour time frame. The first objective is to identify the draw on liquidity and establish a clear directional bias. Without a draw on liquidity, no trade exists within this model. Once the draw on liquidity is defined, premium and discount zones are marked, and a price delivery array aligned with the direction of the draw on liquidity is selected as a point of interest. The model then transitions to the 5-minute time frame. The 5-minute time frame serves only two purposes. First, price must retrace into the higher time frame price delivery array. Second, liquidity must be swept within that area. If either condition is missing, the setup is considered incomplete. After these conditions are satisfied, the model moves to the 1-minute time frame for execution. On the 1-minute chart, the model waits for clear entry confirmation, such as a market structure shift, displacement, or a confirming price delivery array. The entry is executed only after confirmation is present, with risk clearly defined. If price does not retrace into the point of interest, the model does nothing. If confirmation does not appear, the model does nothing. Trades are never forced. Price must come to a favorable level and demonstrate alignment with the higher time frame objective. The model allows for continuation entries, re-entries, and structured trade management, as long as higher time frame structure continues to support the same draw on liquidity. When the draw on liquidity is reached, the model considers the objective complete. This approach emphasizes discipline over activity and precision over frequency. The continuation model is not designed to capture every movement. It is designed to capture high-probability continuation moves by aligning multiple time frames under a single objective. This is how the continuation model is supposed to be traded. That's it for this video. If this helped you, make sure to like the video and subscribe to the channel. If you want to join my mentorship program, the link is in the description. And for any questions or doubts, you can join my Discord. I'll see you in the next one.